Hi, I'm your host, Bob Powell. We're proud to welcome you to the Exceptional Advisor podcast series brought to you by the Investments and Wealth Institute. This series aims to help you to better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. My guest today is Waldean Wall, Vice President, Advanced Markets and Solutions, Allianz Life Insurance Company of North America. Waldean, welcome to the podcast.
Thank you, Bob. It's great to be with you.
It's a pleasure to have you here. Before we get started, for the benefit of our listeners who may not be familiar with you and your work, do you mind giving us a brief overview?
Sure. I've been in the financial services business all my working career, really. Started in the tax end of things, ran a tax office, did some tax consulting. Then I was an advisor for 20 years, and I've been with Allianz now for about 20 years also. And so I'm in the advanced markets and solutions area. We try to help advisors just be better at what they do. So we don't talk a ton about product. We're just trying to help advisors with ideas and concepts and strategies that they can use.
So there are a number of tax problems that clients of advisors will face in retirement. We're going to have you walk through what you view as some of those problems, and then we'll talk more about the solutions to those problems.
That sounds good. Yeah, well, here's the deal. As of the third quarter of last year, there was over $37 trillion in retirement plan assets. And over 60% of that money was in self-directed accounts. And, if you're like me, you're pouring money into those accounts, trying to get ready for retirement. And so, apart from a market that isn't cooperative, these accounts are just going to keep growing. And that's fantastic when we're preparing, but it's all ordinary income. And it all has to come out, and it has to come out in kind of a defined period of time. And for those that have really done a good job in getting ready and managing budgets and accumulating, obviously, retirement plan money, there are some tax issues that are becoming significant. And the thing about this is it's not just the multimillionaire type person that owns a prosperous business. This is for the middle class, upper middle class type person, as well as for those who have done even better. And this is the problem, because this group of folks isn't really used to the tax man coming into the picture the way he probably will. And so this is an area of planning and discussion that is really emerging as critically important. So let me just talk about three problems that are coming. They're on their way. And like you said, then we can go from there. But the first problem is perpetual deferral. Defer at any cost for as long as you can. Now, that used to be the way to do it. Well, almost without a doubt. Almost everybody could come out ahead by simply deferring as long as possible. Never pay tax before you have to. But we didn't have these retirement plan assets then either. I mean, when I got into the business, there was no 401k or IRA. And even then when there was, it still took a long time before there was a $100,000 account balance. And now we're seeing, diligent folks that have just focused on saving, that they're going into retirement and they're, combining their mom and dad, combine all their accounts. They've got $1 million, $1.5 million, $2 million. And that's not all that unusual. I'm not saying it's normative, but it's not that this is where it's going. So here's the problem. I mean, it's good news, bad news, right? That's all your money. So these accounts are owned by the individual. And the natural response to that is to manage your finances so that you can keep as much of that as possible. So there's a surprising number of folks moving into retirement that are planning to not take withdrawals until they have to. And on the one hand, that's great. They've managed their situation so that they can keep as much as possible, but they may be in for a real surprise, because when you have all of this money that has to come out through required minimum distribution, and let me give you some numbers here. If someone goes into retirement with $2 million, mom and dad, they go into retirement, or they're age 65 and they have $2 million, and they're just going to simply try to only take RMDs. And now let's assume that this $2 million gets 6% a year. By the time they hit 72, the first RMD is $132,000, $133,000. That's just the first one. And that comes out on top of everything else, right? That's taxed on top of all their other income. By the time we hit 82, we're at $198,000, $199,000. And by the time we hit 92, we're at $165,000. And we've still got a whole bundle of money to go to the next generation, right? So, man, when you start dropping $200,000 of ordinary income on top of everything else you're doing, not only do taxes probably go up significantly, but Medicare Part B premiums, the 3.8% surtax. I mean, there are all kinds of things that are just waiting to jump on you when we increase our AGI like this. Yeah. So again, for many people, deferring is the right way to do this, but for an increasing number of people, perpetual deferral probably isn't the smartest thing to do. So that's problem number one. Problem number two is the one that I find takes most people by surprise. So let's say we have the folks that we illustrated in the first situation. Mom and dad done a great job in saving money. They're only taking minimum withdrawals. And now someone dies. Dad dies, let's say at age 80. Well, now think about this. Mom gets all the retirement plan money. Her RMDs are now increasing. So she's got compressed tax rates because she's filing as a single person. She's got reduced standard deductions anyway. The threshold for Medicare Part B and D premiums are even lower than they were because now she's single. The surtax starts at even lower levels than it did when they were married, because that's the way that law is written. Those hurdle amounts don't change, right? So we have a problem that was bad, now is much worse. In fact, we've run analysis on this at, what I would say reasonable income levels. After dad dies, mom's taxes they double. And the smallest Social Security check is now gone too. So that money needs to come out of the IRA. And so now what we thought we were doing the right thing by deferring. Wow. Now we have a double whammy going on here. Yeah. And if you're an advisor listening to this, I would encourage you, depending on obviously the software you use, but run these kinds of scenarios. I have found that the average person who's done well does not see this coming, never heard of it. And it is breathtaking when they actually realize the impact that this could happen. And this makes folks really want to kind of figure out, well, what can we do? Yeah. So that's the second problem. Now, the third one is big, and it's getting bigger all the time, just like the first two. This is leaving a big pile of taxable income to the next generation. And we've always known that a retirement plan is probably not the best asset to leave to the next generation, but we haven't had the kind of money that we have now either. And so, as you might know, if you're an adult child and if you're not chronically ill or disabled, you can't stretch anymore. Now the retirement plan, the inherited IRA, for example, must be empty by the end of the 10th year following the year of death. Now, a lot of advisors will look at that and say, well, what's the big deal? Kids just take the money anyway, and they go buy a car and I get that. And that is was true, but the more money that's moving to the next generation, the more the kids are conscientious on this whole issue of keeping as much as possible, right? So when they passed this rule, the Joint Committee on Taxation did a quick analysis of the impact that this might create. And they figure that just in this decade, they'll raise an extra $16 billion of tax revenue, right? And the bigger these accounts get, the more money they'll raise versus stretch. So this is saying they would raise 16 billion more than if these bennies could stretch. So let me give you just a kind of an idea as to what this looks like. So we have a child with a taxable income of $80,000 a year, a single child, taxable income of $80,000 a year. And now they get $1 million, from mom. And if that person was 45 when they inherited the money, they used to be able to stretch over 40 years. They had 40 years to pay the tax on this money. Now that account has to be empty by the end of the 10th year following the year of death. And again, $1 million. Now we're assuming a 5% return on this million. But if they put this equally into their income over that 10-year period, that would be $123,000 a year over and above everything else. And the end result on this they would lose well over $300,000 just federally on this million, right? So I don't think that's an extreme example. That's not a ridiculously, highfalutin example, but this is what's coming. So there is a bullseye on these retirement plan assets. And so that's why I say, I have a separate discussion that I have just for clients, for non-financial people around these three problems. And the response to getting this information has just been amazingly interesting. They just have no idea that this is coming. The follow-up question is, well, so what do we do?
Yeah. So what do we do? Thanks for the cue.
Yeah. Well, here's where it gets a little complicated if you're an advisor and you're not really comfortable with how taxes work, right? And so let me just start there. This is an ever-increasing area of conversation in our industry. It's not going away. So if you're an advisor and you're just not comfortable with how you understand taxes, you got to change that. Continuing ed, separate courses, classes, you have to change that because this is where the business is going, or at least a significant piece of it. These are the kinds of clients we want. These are the kinds of clients we need to be able to communicate with such that they understand. And there are often very few motivating issues like this one. So you want to be able to speak to it. Now, just as an idea here, I make sure when I talk to folks that I'm not always talking about tax savings. I'm talking about keeping as much as I can. Now, you might think that's the opposite side of the same coin, and it might be, but people respond to that. Some people respond to that language. We're just trying to help you keep as much of your money as you can versus let's not pay any more tax than we have to. I mean, they might be the same thing in many cases, but people respond differently to the language we use. So this really is about keeping as much as we can. So I'm not sure we have enough time to talk about all the various strategies, but let me start with, what has maybe is the simplest one. It's been around for a while, Roth conversions, right? So I'm convinced personally, having dealt with hundreds of people, that for most, there is a great opportunity for Roth conversion, at least at some point in their financial lives. So Roth conversion, right? You're moving money from a traditional retirement plan that's all taxable, and you're basically moving it into a Roth IRA. And now all the growth is tax-free as long as you follow all the rules, right? And the problem that I'm running into on the discussion of Roth conversion is many clients and actually some advisors don't understand the math behind Roth conversion. So for example, you talk to John, a client, and you think it might be a good idea for him to convert $30,000, $40,000. And John says this. John says, well, okay, I've heard about Roth conversion. I think I know how it works, but if I don't do the conversion, then I can keep the tax money that I would pay when I do the conversion. That is mine. I haven't let that go. So I can grow that money for another 10, 15 years, as well as the IRA itself. And so then if I have to take the money out later, I can afford actually to pay a higher tax rate on that money because it grew. Now, this conversation between you and I, Bob, is going to get a little complicated here. So I'm probably not going to be able to actually define all of this. But that argument is not legitimate. There is no time value of money component to analyzing a Roth conversion. And this is where advisors make a mistake, because if a client says something like this, and an advisor doesn't know how this actually works, they'll be thinking, oh, maybe that's a good point. Maybe these Roth conversions aren't as big a deal as as I've been led to believe. No. You've got the math wrong. There are only two things that matter. What is the tax impact now? And what is the impact later? Now, the tax impact now would be the tax impact to the person that's doing the conversion. The impact later might be to the person that's doing the conversion, but it might be the surviving spouse, right? It might be the kids who get the retirement plan. So in terms of later, not only do we have to kind of think about, okay, well, who's going to get this money, but what are the other costs associated with getting this money? Like increased Medicare premiums and the 3.8 surtax and so forth. But the long and short of this is there are only two components to this: taxes now, costs now, costs later. That's it. This confuses people sometimes. Oh, I don't, how can that be? Well, we're not going to be able to delineate that here, but that is the way that works. And you need to, do the math on this and find out so that you can be convinced that this is how it works, so that when your client, then who likes to pay the tax? I don't, but I do want to keep as much as possible. And what I've found is that if the client can just understand what's coming and understand how Roth really works, Roth conversion really works, they're much more open to doing it. And the last thing I guess I'll say about Roth conversion is, again, be careful here, and maybe you get help with this. But I've done these Roth conversions discussions, and now somebody will come, oh, this is great. I have a client, I think we should convert $300,000. It's like, no, stop. Now, all the tax you trigger by converting $300,000 makes the conversion itself not work. So you have to have a little bit of an idea as to what their taxes look like today and where they might be going given their situation and so forth. So Roth conversion is kind of like tax strategy 101.
Yeah. So Waldean, just to interrupt for a second, it sounds like you would be advocating for partial conversions, perhaps.
Oh,
is that
absolutely,
right?
absolutely. Yeah. A series of conversions.
Right.
Visit with your client every year. Take a look at a tax return. How far below their top of their tax bracket are they?
Mm-hmm.
And depending on everything else, maybe it's a good idea to at least convert up to the top of their current tax bracket. So right, absolutely right. It's you have to be connected to the issue in a very real way to see how this works. Now, the last thing I'll say about it, still, some people say, well, when do you find scenarios that fit Roth conversion? Now, Again, I'm not trying to make this a small answer because those scenarios can appear at any time, but often Roth conversion isn't appropriate, often, not always, isn't appropriate when clients are in their peak earning years, right? Because now their tax rates are as high as they've ever been. So person in their 50s and their 60s, making as much money as they ever have, paying as much tax as they ever have. I'm not sure that Roth conversion is a good idea there generally. However, now they slide into retirement, or now they get their house paid off, or now they start downsizing on some of their expenses. At Allianz, and I'm sure you've heard this too, we have the go-go years, slow-go years, no-go years, right? So the go-go years, right after a person goes into retirement, we still might be absorbing as much taxable income as we ever have. But now you slow down. And at some point in time, you may not be going anyplace. Often the tax impact, the tax situation changes during these phases. So look for the reasonable tax rates, big balances in retirement plans. So that's kind of my short version of Roth conversion.
Right. You have some other solutions too.
You bet. What we're doing with Roth conversion is we're basically taking money out of the traditional retirement plan, right? Paying tax on it. I mean, kind of, I'm dissecting it here, and now the money's in a Roth IRA. Well, think about that. What if we took money out of the traditional account, IRA, paid tax on that money, and bought life insurance? Right? In some ways, we're doing the same thing. I mean, the tax paying is the same. We have to pay the tax, but one, it's going into a Roth account, and the other, it's going into life insurance. Now, I'll just tell you that at Allianz, as soon as the Secure Act started changing the dynamics of stretch, our life insurance sales started to go up immediately. And obviously there are issues around insurability and all those kinds of things. I get it. But for the right person, especially if we're trying to plan as early as possible, which is always a good idea. Sometimes we know what's coming. We just know what's coming. So then the sooner we take action from a tax standpoint, the better off we might be. But life insurance can be a very, very viable approach to this in a number of different ways. For one, now we have a death benefit early on that can generate capital, tax-free capital, in addition to what's left in the IRA, right? So that number one. Number two, with life insurance, we can actually very easily manage the distribution of that asset through a trust. And so I don't know that I want to go down that rabbit trail in terms of how this all works, but there are some dynamics that life insurance has that are really, really helpful. And at the end of the day, the management, the distribution, the tax-free nature of the capital can just simplify things and can create real impact. So, consider life insurance. Obviously, the situation has to warrant it, and we have insurability issues and so on and so forth. So I get it, but life insurance is a viable connection to this problem. Let me talk about another solution that I have found clients just really like. Advisors really like it too. The truth is, most people haven't heard of this before. So I'm going to try to explain it in a way that's understandable. Split beneficiaries. So let's say, again, we have our stereotypical mom and dad, and they're trying to defer as much as they can for as long as they can. And it's the tax problem number two, right? Dad dies, it all goes to mom. She's filing as a single. Her RMDs are ramping up. Taxes are now out of control. When all along, we knew that this money was probably destined for Joan, the daughter, right? Why don't we leave Joan some of this money after the first death? So here's what happens. Let's say dad dies, We leave Joan half of the account at the first death. Joan can now open up a 10-year distribution window on half the account. And mom's RMDs just went down. They were just cut in half because she didn't get all the money. And now at mom's death, Joan gets the rest of the account, and now she can open up a 10-year distribution on that. So it's almost like we're creating a 20-year stretch. When the light bulb goes on around this concept, it's like mom's looking at dad, dad's looking at mom, and it's like, hey, we've never thought of this. And what I've also found is this is when you as an advisor share the concept, your clients know that you know things they don't know. Yeah. I mean, it just increases the value of your stock a lot. The other thing that's nice about this concept is it's very easy to implement, right? This is just a beneficiary adjustment. And you can review and readjust as often as is appropriate. And the other thing that's really good about this strategy is that often we don't know who's going to die when. So the concept of the strategy is great. We can implement it in theory, but we still don't know who's going to die when. So we probably need a plan B also, right? So this is probably not a standalone have solved all your problems type strategy. This is very helpful, but you probably need a plan B here too. So I've just found that this, for the client base that we're talking about, it's inevitable usually that kids or a child is going to get some of this, some of this money. So that was number 3. Let's talk about another one. Let's talk about a donor advised fund. We can certainly talk about a donor advised fund as a standalone strategy, but we can also talk about it in combination with other things. So let's say you have a client in their 50s or 60s or just moved into retirement, and they give money away, right? They give money to their church or to their synagogue or to PBS or to other charities. And lots of folks could use the help right now, but they're charitably inclined. They've done well, and they plan on giving money regularly as long as they're alive or as long as they're capable. Well, what if we pre-fund some of those future donations strategically, right? A lot of times folks that have done well will also have money in cash, sitting in the bank or sitting in bond funds that are just doing almost nothing. We could put money in a donor advised fund and get the deduction today. Get the deduction today for money that we actually won't give until into the future. Now, there are all kinds of strategies when you talk about a donor advised fund, but I'll just share a strategy as it relates to these 3 tax issues. So if you have clients, let's say they're, now maybe a good time to contribute to the donor advised fund is when you are in your peak earning years, right? We talked about, Roth conversion and being careful about that, when it works and when it doesn't. Well, the higher your tax bracket, the better the donor advised fund works, because you get a tax break in your bracket. Mm-hmm. Now, be careful here. We don't have time to go over how much you can put in, what the gifting allowances are and so forth. So you have to do your homework. But what if we did that work and found out that we could make pretty decent contribution to a donor advised fund and really, really lower our taxable income? Well, that would be helpful, right? Because we're going to give that money away anyway, but we can get the tax break now rather than 5 years from now or 10 years from now. And now that we've lowered our taxable income, what if we do Roth conversions to kind of fill up that open space? Now, this is just a concept, right? You still have to be diligent in terms of the numbers. But I have found that more and more people are interested in donor advised fund because they can control when they get the deduction. Now, if you're not philanthropic, I mean, then this strategy probably isn't appropriate, because once you put the money in the donor advised fund, take the deduction, you can't take it back, right? It has to at some point go to charities of your choice. And if you're an advisor and your current affiliations don't have a donor advised fund, they're so easy for your client to set up. I mean, it is just easy peasy. So I use a donor advised fund, and I use it in a little bit of a different way. It is my charitable contributions that actually allow me to itemize deductions, right? So because of my charitable contributions, I have enough Schedule A deductions to exceed the standard deduction limit. So let me just share one more concept with you. Let's say you have clients where that's kind of true, right? So let's say you have a client that gives away $40,000 a year, and they're able to itemize deductions. They have $20,000 more than the standard deduction, right? So they're giving away 40, and they're $20,000 over the standard deduction amount. So really, they got an extra deduction of $20,000, but $20,000 didn't do them any good either, right? So what I do is I give money away in the current year, and then in December of the current year, I fully fund next year's charitable contribution into a donor advised fund, so that 100% of that money is deductible. And then next year I'll distribute to my charities from the donor advised fund, and I'll take the standard deduction. So I'm grouping these kinds of deductions. I will save thousands of dollars over time in taxes just by doing this. So anyway, donor advised fund, very helpful tool if you use it strategically. Maybe the last strategy that I'll share is a charitable trust. And this comes into play with the big money moving to the next generation, the big retirement plan money. So this is for a little bit of a wealthier client that has more money than most in these retirement plans. So here's the concept, right? You actually leave the IRA to a charitable trust that you have set up. Now, if you're an advisor, you probably know that you can design these charitable trusts to actually generate income back to individuals, right? So think about this. You put $5 million at your death into a charitable trust that then distributes lifetime income to your daughter. Lifetime income. And then your daughter pays tax on that income as she receives it. That looks like a stretch, right? That's what they were doing here. We are basically creating a stretch through the use of a charitable trust. Now, a couple things here. Some of that money in the charitable trust does need to go to charity. So if you're not charitably inclined, the strategy can still work, but you need a lot more money, to make the numbers all work out. If you are charitably inclined, this could be a viable concept for $2-3 million or more. I mean, if you're basically saying, look, I do at some point want to give money to my college, or again, church or synagogue or other charity. So that's going to happen anyway. Well, now the actual cost component of the charitable trust just went down in terms of creating a stretch alternative. So because this trust will have to be maintained, right, while your beneficiary is still around, and then when the beneficiary dies, then the whatever's left goes to the charity. Which brings up kind of the last point in the charitable trust. If you had a large retirement plan that you left to a charitable trust and you gave it, and you had income to your children, the risk in that is that your child might die before you expect. And so now the child's estate didn't get the money that was coming from to them, really. So if you're going to use a charitable trust, you should think about also insuring the children, the recipients of the income from the charitable trust, so that one way or another, that money, their family is going to get that money. It's just that we can mirror a stretch by the use of a charitable trust. So, I might end this too by saying more and more advisors are actually creating this tax discussion on the front end of client acquisition, because tax planning is almost always better done early rather than later, being proactive rather than reactive. And so this is a major component of financial planning that is emerging as vital. And I guess I would just say, for most advisors, if you're not offering insight here at a minimum, somebody else probably will. Yeah. So we really have to help here.
So, Waldean, before we wrap up, with respect to charitable giving, there's one solution that I'd love for you to address before we conclude, which is QCDs, or qualified charitable distributions. Yeah. Care to comment on that?
Well, sure. And this is where, so I've mentioned the donor advised fund. I've mentioned the charitable trust. Now we're going to talk briefly about the qualified charitable distribution. So this is where the advisor really has to understand what strategy fits when and where. So we can talk about all of these concepts, but they don't all apply to everybody. This is where your skill as an advisor really comes into play. So what we're talking about now is moving money from your retirement plan directly to a charity. And when you do that, now they changed RMD rules so that 72 is now the age. The age is still 70 and a half here for this. But certainly what you can do is move money directly from your IRA to the charity. So the IRA writes a check out to the charity. They can send that check directly to the charity, or they can send it to you and you can deliver it. You could do that with a maximum of $100,000 a year. That distribution, whatever it is, counts toward your required minimum distribution. So that is completely appropriate and valid and valuable. It reduces your IRA balance, and the money never shows up in your adjusted gross income or your taxable income. So this, for most people, for many people, this is better than taking the withdrawal from the IRA, giving the money away, and then deducting it on your Schedule A. When you do that, it still shows up in your adjusted gross income, right? And so by moving the money directly from your IRA to a charity via qualified charitable distribution, you don't increase your AGI, and that is really, really helpful. So there are many, many things to talk about. There are even more, actually, but your role as an advisor is to know what strategy fits when and where. And I would say it's just as important that you are able to explain the situation well, so that your clients will open their mind to the possibilities that you are talking about. Because if we mess up the communication on some of this, like a Roth conversion, right, we had to pay taxes on that. If we haven't explained it well, then that becomes prohibitive, and we don't want that.
So, well, Dean, we've covered a lot of ground. Anything we missed, or anything that re-emphasizing?
Anything we haven't missed a single thing.
Well, that's great.
Well, I want to say, and I always struggle a little bit with these kinds of conversations, because the concepts sound like, oh, that's a good idea, let's do that. Please be careful. Get advice, get help, work with a Work with a CPA, work with a tax professional. If you do the wrong thing here, that will be a problem for everybody. So just be careful. But this is really, this whole concept of tax strategy, tax issues that are becoming a big piece of the discussion.
Yeah. Well, Waldean, I want to thank you for sharing your knowledge and wisdom with our listeners today. It's greatly appreciated.
My pleasure. Always good to see you.
Thank you for listening to the Exceptional Advisor podcast brought to you by the Investments and Wealth Institute. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or our website at www.investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. For additional resources, updates on events, and exclusive membership deals, visit www.investmentsandwealth.org.